Is a credit card good for you or bad for you? The honest answer is it depends completely on how you use it. Use it correctly, and a credit card can help you build credit, track spending, earn rewards, and add protection to some purchases. Use it like extra income, pay only the minimum, or spend money you do not already have, and the same card can keep you paying interest for years. So this video is not simply going to tell you that credit cards are good or that credit cards are bad. We are going to understand the complete system in 6 simple parts. We will cover what a credit card really is, whether you should have one, which card and limit may fit you, how the minimum payment trap works, when to use credit instead of debit, and the final rule that can protect you from interest. By the end, you should be able to look at any credit card offer or statement and understand what matters, what can cost you money, and what action you should take. Now let us move to part 1. Part 1. What is a credit card and how does it actually work? A debit card normally uses money that is already in your bank account. If you spend $100, your bank balance usually falls by about $100 immediately. A credit card is different. The card company pays the merchant first, and you repay the card company later. That means a credit card is a short-term loan attached to a payment tool. The plastic card is not the money. The available balance is not your money, and the credit limit is not extra income. It is simply the maximum amount the issuer may allow you to borrow. For example, if your card shows a $20,000 limit and $15,000 available, that does not mean you own $15,000. It means the company may still allow you to borrow another $15,000. Your true spending power is the cash you can safely use to repay the bill after rent, food, insurance, savings, and other commitments are covered. At the end of a billing cycle, the issuer creates a statement with a due date and several different numbers. The minimum payment is the smallest required amount that generally keeps the account from becoming past due. The statement balance is what was billed when the cycle closed. The current balance may also include newer purchases. These numbers are not interchangeable. Paying the minimum can prevent an immediate late payment problem, but it does not mean the debt is paid or that interest was avoided. For a cardholder who has a grace period and is not already carrying a balance, paying the full statement balance by the due date is generally what avoids interest on purchases. So the first lesson is simple. A credit card is borrowed money. Even when using it feels almost identical to using debit. Now let us move to part 2. Part 2. Should you get a credit card? A credit card may be useful if you have predictable income, a working budget, and a reliable method for paying the bill. It can help establish payment history, organize transactions, and provide useful purchase or dispute protections depending on the card. But ask yourself one important question. What problem am I expecting this card to solve? If the answer is convenience, tracking, protection, or planned rewards, the card may support your system. If the answer is I need it because my salary finishes before my essential expenses, the card is not solving the shortage. It is moving this month's shortage into next month, where next month's expenses are already waiting. Use a simple test. Can you explain exactly how the statement will be paid? Could you still pay it after an imperfect month? And does delayed payment help you control spending or make the spending easier to ignore? If shopping, food delivery, or social spending becomes harder to control when payment is delayed, debit or cash may be the better tool. Waiting before applying is not a failure. It may be the smartest decision until your budget and emergency savings are stronger. Therefore, a credit card is good for a person who controls it with a system. It becomes dangerous when the card begins controlling the person's monthly decisions. Now let us move to part 3. Part 3. Which type of card should you choose? What interest rate is best? And what limit should you accept? There is no single best card. The correct choice depends on your credit history, behavior, and whether you will pay in full. A secured card is designed mainly for building or rebuilding credit and normally requires a refundable deposit. A no annual fee cashback card can be a simple option for everyday spending when you always pay the statement balance. A low APR card may be more valuable than rewards if there is any real chance you will carry debt. A 0% introductory or balance transfer card can help with a planned payoff, but you must understand the transfer fee, the promotional deadline, and the monthly payment needed before the offer expires. A premium travel card is useful only when the benefits you genuinely use are worth more than its annual fee. Before applying, compare the APR. Annual fee, late fee, foreign transaction fee, cash advance terms, grace period, and promotional expiration date. A welcome bonus can be worth hundreds, but high interest can cost thousands. What interest rate should you look for? The lower, the better. If you pay the full statement balance and keep your grace period, purchase APR may not affect you. If you carry debt, APR becomes one of the most important numbers. What about the limit? A high limit can help keep utilization lower when spending stays controlled, but it can also feel like permission to spend. The common guidance of staying below 30% utilization is a ceiling guideline, not a spending target. If the bank approves $20,000 but your monthly budget safely supports $1,500 of card spending, your personal limit is $1,500. When you reach that amount, stop using the card for the month, even if the app says you still have thousands available. Choose the card for your real habits, not for the lifestyle shown in the advertisement. Now let us move to part 4, where the numbers become very important. Part 4. What really happens when you carry a balance and keep making a small monthly payment? Let us use a practical example. Assume the credit card balance is $20,000. The annual percentage rate is 22.15%, close to the latest Federal Reserve average for accounts that were actually charged interest. Assume there are no new purchases or fees, and the cardholder pays a fixed $500 every month. $500 sounds like a serious payment, and it is, but the full $500 does not reduce the amount borrowed. In the first month, estimated interest is about $369. That leaves only about $131 to reduce principal. The bank account falls by $500, but the card balance falls from $20,000 to only about $19,869. Why does this happen? Interest has accumulated under the card agreement. The payment covers that interest cost, and only the remaining amount reduces principal. When the balance and APR are high, interest can consume most of a payment. Now let us move forward 12 months. The cardholder has paid $6,000. However, approximately $4,260 went to interest. The original balance fell by only about $1,740. More than $18,260 is still owed. Now move forward to month 24. The cardholder has paid a total of $12,000. Estimated interest is roughly $8,094. Only around $3,906 reduced principal. After paying $12,000, the remaining balance is still approximately $16,094. This is why someone can truthfully say, I paid every month, but my balance hardly moved. Paying on time and paying off debt are not the same thing. The minimum payment may protect the account from becoming immediately late, but it is usually not an efficient payoff strategy. Our spreadsheet uses a monthly APR divided by 12 estimate. Actual issuers may calculate interest differently, so exact results vary. The lesson remains. Expensive interest can absorb a large part of every payment before principal moves. If new purchases continue or the payment falls as the issuer's minimum falls, repayment can take even longer. Now let us move to part 5 and build a system that prevents this situation. Part 5. How should you use a credit card? And when should you use debit instead? The most important rule in this video is Use your credit card like a debit card. Before every purchase, ask, if this money left my bank account today, could I still afford the purchase and all my important bills? If the answer is no, the credit card has not made the item affordable. It has only delayed the payment. Here is a 5-step system. Step 1. Create a personal monthly card limit based on your budget, not the issuer's credit limit. Step 2. Reserve money after every purchase. If you spend $84 on groceries with the card, move or mark $84 inside a separate card payment category. Treat that money as already spent so it cannot be used twice. Step 3. If your cash flow safely supports it, set automatic payment for the full statement balance, not only the minimum. Also create an alert several days before the due date so you can confirm that enough money is available. Step 4. Review the account for 5 minutes each week. Check for duplicate transactions, subscriptions, fraud, fees, and whether the reserved amount still matches spending. Step 5. Choose credit or debit according to the purpose. Credit can be useful for planned groceries, fuel, recurring bills, travel bookings, and online purchases when the cash is already reserved. Debit or cash may be better for ATM withdrawals, merchants charging a card fee larger than the reward, or spending categories where delayed payment makes you lose control. Avoid credit card cash advances except as a genuine last resort. They commonly begin charging interest immediately and may also include a fee and a higher APR. What if you already have a balance? Consider pausing new purchases so the target stops moving. Pay the required amount on time, add as much safe extra money as possible, and ask about lower rate or hardship options. A balance transfer helps only when it's fee. Deadline and monthly payoff create real savings and the old card does not fill again. The goal is not to be afraid of the card. The goal is to make every purchase intentional and already funded. Now let us move to part 6. Part 6. What benefits can a credit card provide and what final rule should you always remember? Used correctly, a credit card can support a record of on-time payments, make transactions easier to track, provide cash back or travel points, and offer useful purchase or dispute protections depending on the card. These are genuine benefits, but only when the card does not create expensive debt. Rewards should be treated as a discount on planned spending, not as extra income. At a 2% reward rate, $20,000 of purchases earns $400. In our calculation, only the first month of interest was about $369. By the second month, interest can already exceed the value of the entire reward. Never spend more just to collect points. If a purchase was not planned and affordable, the reward does not make it wise. When the statement arrives, read all 3 important numbers. The minimum payment helps prevent an immediate late payment problem. The statement balance is generally the amount to pay in full by the due date when you want to preserve an available purchase grace period. The current balance shows the statement amount plus newer activity. Now the final pro tip. Every time you tap, swipe, or click Buy Now, imagine the same amount leaving your bank account immediately. Reserve it and treat it as gone. Use credit like debit. Borrow for seconds, not for years. A smart user is not the person with the highest limit or most points. It is the person who receives useful benefits, pays the statement balance, and avoids expensive interest. So, is a credit card good or bad? It is good when it supports spending that is planned, affordable, and paid in full. It is bad when it becomes additional income, hides overspending, or keeps debt revolving from one month to the next. Which rule will you apply first? Setting a personal limit, reserving money after every purchase, or paying the full statement balance? Tell us in the comments. And subscribe to Business Decoded for more clear, practical explanations of the financial systems affecting everyday life.